From New York City for our audience worldwide, I'm Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, closing out 2019, Treasury yields approaching 2%, looking for the Fed to remain firmly on hold through 2020 as the junkiest parts of junk debt finish the year on a high. We begin with the big issue, investors looking for rates to stay low for a whole lot longer.
It's hard to really see the yield break out from here.
Bond yields moving sideways.
Trapped in this range.
It should eventually be a good year for bonds.
Still attractive, but certainly not breaking out.
120 by the end of the year.
To get to 1.2% on the 10-year, we'd probably have to be looking at a global recession.
The risks are more skewed towards the downside.
We're going to test 1%.
A lot of things would have to go incredibly wrong to get down to 1%.
And if I'm wrong, I think we're going lower.
You have to have a recession to get there.
The U.S. economy could potentially go into a recession.
Unless the market begins to price in additional cuts, the 10-year at most is going to drop down to that 160 range in a trade truce.
The Fed will have to come back and ease again.
The Fed's probably not going to cut again.
The Fed is going nowhere.
If there is any sort of weakness in the data, you're going to see that an outsized rally in bonds.
Joining me around the table here in New York, Kathy Jones at Charles Schwab, George Bory of Wells Fargo Securities, and joining us from Chicago, Jim Bianco of Bianco Research. So, Jim, let's begin with you. Looking out to 2020, it just seems the consensus view is for rates to remain where they are or go lower. Where do you come down in that debate right now?
Yeah, I think that's probably right, that the rates will probably drift lower. That's been the story of the last 10 years. We've had no inflation. We're in a record expansion. We can't generate any inflation right now. Rates are down 75 basis points this year, at least on the 10-year yield. The path to least resistance has been for a decade lower, and I see no reason to think that that's going to change going into 2020.
Kathy Jones, your take?
Well, actually, we're calling for higher rates this year. Not a huge breakout to the upside, but we're looking for 2.25% stretch to 2.5% on the 10-year. And the reason is, unlike last year, we were starting at a higher level with the economy slowing down. Now we're starting at a lower level with the economy looking a little bit better, the global economy in particular. And we see room for the term premium to come up a little bit, inflation expectations to pick up a little bit.
George Bory?
Yeah, I'd say we're in a similar camp in the sense that we think that rates have room to move up from here, roughly 2.25 is sort of our target.
Yeah.
And I think you can kind of summarize it in a very simple way. We expect growth to be upwards of 2%. We think inflation's going to be around 2%, and we think the 10-year yield on average will be about 2%. So it's kind of a 2 by 2 by 2 forecast, if you will.
Similar data points that we've experienced this year as well. So what has taken us to 225 when we experienced rates of in and around 150 with exactly the same economic backdrop this year that you're predicting also to repeat next year?
Yeah, well, I think like Kathy said, I think the difference is growth differentials. And although the economy decelerated this year, our expectation is the economy is going to pick up a little bit and start to reaccelerate next year. That in and of itself will allow yields to move a little bit higher. And we think the Fed's going to be anchored. We don't think the Fed's going to do anything. So, the monetary stimulus you saw in the middle of this year starts to filter its way through both domestically and internationally, and that just basically helps boost growth incrementally.
Jim, we're arguing over 25, 50 basis points maybe, but what are your thoughts on GDP starting to pick up again as the new year starts to grow a little bit older?
I think that there's possibility that it can pick up, but I'd also remind you that the U.S. rates, with a 2 handle on the 30-year, we have the highest rates in the developed world for the first time in history. I think that really global growth is what matters for the bond market. And with all those other rates being lower and a lot of them being negative, and they're going to probably stay there, that's going to be a tremendous downward pull on our interest rates. We cannot remain the outlier, I don't think, in terms of interest rates. We've never been here before as the highest rate, and I don't think that it's going to stay that way for much longer. So either the rest of the world's going to have to come up a lot, or we're going to continue to be pulled lower, and I think the pulled lower is going to be what we'll see first.
Well, Jim, let's talk about what that means for the shape of the yield curve as well. George, your thoughts on that? 2s out to 10s. We're ending 2019 with some steepness relative to where we have been, the inversion of the middle part of this year and through the summer. 2s to 10s out to around about 30 basis points. Your take?
Right. So we think there could be another, sort of 10, maybe as much as 15 basis points in steepening. But I would say 5 to 10 is probably a good central call as the Fed kind of stays anchored. You get a modest uplift in yield. So that's one of our highest conviction views, is just position for a steeper yield curve next year. And we think that kind of positioning is going to work best for you.
Kathy?
Yeah, I would agree. Looking for a steeper yield curve because the Fed is going to stay on hold. I think if there's a surprise this year, it's that we do get a little bit of a lift in inflation and inflation expectations. It's starting to build a little bit, and we've seen the break-evens in the TIPS market come up. So I think if there's a bit of a surprise, it might be a little bit more inflation, or at least the expectation of it, than we've seen before.
Well, let's start to probe what that means for the consensus call going into next year. There is just this overwhelming belief, and this is a take from Morgan Stanley, which I know is shared by many people watching this program and across Wall Street, that risks are skewed asymmetrically to cuts over hikes in 2020, that the reaction function of the Federal Reserve has shifted. Is that your take too, Kathy?
Well, I think they definitely would need to see, as Jay Powell said, a material change in the outlook to make a change. And I think the interpretation of that was, boy, we'd have to see a much worse economy in order to start cutting again, and we're not even considering raising rates. But if we're right that we see a little bit more upward pressure on inflation, that sort of expectation might shift in the second half of the year.
Jim Bianco, do you share that view, just to bring you back into the conversation, that the Fed is just not going anywhere through 2020? Do you have an understanding of the threshold that would bring the Fed back to the table?
No, and I don't know if any of us really do. Remember, the Fed did this big Fed Listens tour throughout 2019, and they're going to, in the first half of next year, roll out some kind of a new policy directive. It's expected to be some kind of an average inflation targeting policy, which means that even if we get that uptick of inflation expectations, the Fed is going to allow it to happen without even considering raising rates. So I think that raising rates, unless something dramatic happens, is off the table. Lowering rates, now there's a lot of things that could happen that could make rates go lower. The uncertainty around more trade, the phase 2 talks, the elections, and don't forget just a correction in the stock market. As much as they want to say that doesn't matter, it does, and it does every time it happens.
So, Jim, how do you push that view through the rest of the yield curve? Presumably the front end would be pretty anchored in the environment that you described. What does it mean for further out?
Yeah, I think the front end is going to stay anchored. I do think that if long rates come down, the problem with the yield curve is it's a corollary to your rate call. Since I've got a rate call of lower, I think that the yield curve could be flatter. If there's going to be a surprise in the yield curve call, it's because the repo market does not seem to be fixed. I mean, we're going to get through year end, but we're going to continue to have $60 billion a month of buying of Treasury bills, and that could continue to push downward pressure. The funds rate is trading on the lower end of the target that the Fed has. With all that stimulus they're pumping in, there's a potential that they could break through, the funds rate could break through, and you could see a 140 or something on the 3-month bill without the Fed moving because of what's happening in the repo market.
Jim, one thing I try and do on a program like this is try and work out where the consensus is, where the growing theme is, where the growing consensus is going into a new year, and where you should be pushing back against that, where the pain trade is. Where is the pain trade for the 10-year yield through 2020, higher or lower?
See, I've always thought that the pain trade in the bond market has been lower. I think that most people are really scratching their head as to why we're at a one handle given all of the news, especially with the pain trade being really lower in Europe. And so therefore, I continue to think that is the pain trade right now. If we were to go to the low ones, especially without signs, as you saw in the top, without signs of a recession, if we were to start to go back towards where we were at the lows in August of this year and maybe even lower.
Your thoughts, George?
Yeah, I mean, the pain trade from a capital at risk standpoint would be materially higher rates. The tremendous amount of money has been put into the market across all of fixed income this year.
Yeah.
Massive inflows. And so a lot of that money is committed at very, very low yields. So, a 100 basis point jump in yields means significant capital losses or mark-to-market losses across the market. And I think, Jim has a very good point, but I think the high consensus view is the range, is a relatively tight range. And I would say it's basically, let's call it 150 to 225 is basically basically the range. You go outside of that range and vol will go through the roof because, number one, it would be a rush to capital protect if we're breaking above 225 and trending higher. And then if we do start to go below that 150 level, again, it's sort of duration extensions. It's, sort of people really, as Jim said, you're going to really see a meaningful scramble to kind of get yourself invested and stay invested in just a very, very low yield environment.
Final word, Kathy.
Well, I think the pain trade is lower, but for a different reason, and that's because spreads are very tight in the credit market. If we're going below 150, that means the economy is doing very poorly. Spreads are way too tight in that environment. So if we're going down there because we're on the cusp of recession, the yield chasing and this, sort of Goldilocks scenario for credit will have to reverse itself, and I think that's where the pain is.
You're saying we needed a recessionary environment to experience some of these targets that are out there, 120, 125, sub 150. That's what we need.
Yeah, I think so. And if we get that, that means that credit spreads are way too tight.
The guys around the table will be sticking with me. Jim Bianco from Chicago staying with us too. We will talk about credit next up on this program. Coming up, the auction block, wrapping up a big year for high yield. That conversation is coming up next. This is Bloomberg Real Yield. Ferro, this is Bloomberg Real Yield. I'd like to head to the auction block now and begin over in Asia on the continent where dollar bond issuance fell to about $560 million this week. Despite the slowdown, 2019 sales delivered a full-year record topping $326 billion. In the US, high-grade issuance slowed before the year-end holidays with sales just surpassing $1.1 trillion for the year, a 4% decline from last year's total. And finally, closing out the year with US junk issuance pushing 2019's yearly sales close to $270 billion. That's more than a 60% increase from 2018. Staying with high yield, Morgan Stanley's Brian Weinstein weighing in on the big rally in triple Cs.
Valuations are tight, right? Credit valuations are tight. High yield valuations are low. Triple Cs having come back. There'll be some supply. There'll be some events. It's not going to be this easy forever.
Back with me around the table, Kathy Jones, George Bory, Jim Bianco still with us too. George, your view on this? What a way to end the year.
Yeah.
Triple Cs, massive rally, 12 straight days of gains. Why?
Yeah, well, I think across high yield, you're basically pulling in, 2020 returns into 2019. And I think there's kind of a year-end squeeze that's going on as people scramble. We just talked about yields in general, look for that recovery trade. Where can I get the incremental yield? Where can I get the incremental return? How can I set myself up for next year? And we've seen a very meaningful squeeze into the market. Triple Cs, if you look across that universe, there's about 10 companies that are up anywhere from 10 to 20% in returns in just the last month.
Is that concentrated?
Just the last month. And that's the interesting thing about triple Cs. It's a very, what we would call idiosyncratic. It's very company specific. It's not an asset class in and of itself. It's a basket of very specific companies that are doing very different things. Now, it is definitely the high beta part of the credit market, so people will use that as a beta trade. But right now, triple Cs are basically a bet on two things, and that's basically energy and then, to a certain extent, retail. And, there are a few other plays in there. But those are your two bets. And so people, I think, have been creeping back into the energy trade as oil prices have come up. And they're looking for that to be the next sort of big play for next year.
Kathy Jones, your thoughts on this? You've been cautious, conservative on this program. Spreads have gone tighter. You've been cautious, conservative on this program. And we're starting to pick up the laggards in triple Cs. Right. As you sit here and look at this at the moment, what are you thinking?
I'm thinking this is this last push where people are willing to buy just about anything in order to get a little bit of incremental return, and they're disregarding the risks involved. So it's not too surprising. It's end of the year, not that much liquidity. We've had a little bit of a rally in oil prices, which has given us a boost. They're not afraid of duration. So it's not too surprising, but would you really want to hold it for any length of time here? We think not.
What do you think, Jim Bianco?
I got to agree with George and Kathy. I mean, the triple Cs in the early part of an economic cycle, it's a bunch of beaten down cyclicals, and that's why you want to run into it when you're coming out of a recession as they rally. When you get a late cycle like we are now, it's the land of misfit toys, to stay with the season. It's a bunch of broken companies that have problems if you're in triple Cs in the 11th year of a recovery. A lot of it is energy. It's been rallying. Energy's rallying. But let's step back from the last 12 days. Triple Cs have been a terrible investment for the high yield market all year. They've lagged everything else. They're highlighted by energy, which has lagged everything else as well, too. I think the only reason somebody would want to buy that stuff is if they're a turnaround or workout player that thinks they could come in, fire management, sell off assets, and restructure the company. If you're not in that game, at this stage, I don't think you want to be playing in that space.
Jim, I want to pick up on something you said. We're in the 11th year. Why is that relevant? I'm just thinking about this because spreads are back to levels where we were 2014, 2018, and you could have taken that as a signal then that we were late cycle, and yet still, here we are, staring down the barrel of 2020 and looking for more expansion. So why is it relevant that we're in year 11 and spreads are where they are?
Well, I think from the Triple C perspective, to stick with that, is that any kind of a cyclical that's been sold off, that was sold off early in the recovery, has recovered. So anything that's left in that category right now when you get late cycle is a problem credit. And that's pretty much all the way up and down the line, is that there's really hard to find value at the lower ends of the credit. It's hard to find value in the triple B sector in investment grade at the end of a cycle as well, too, because it isn't just the general sell-off that you would get coming out of a recession. And that's why I think people have to look at these. I think George had it right. It's just a collection of companies. It's not necessarily thematic. It is thematic at the beginning of the cycle.
The risk, I guess, George, is that this continues, and then you start to look at the other places that didn't participate this year, leverage loans and elsewhere. What are your thoughts on that?
Well, I mean, I think if you kind of look across kind of credit in general, the leading edge of the sell-off was certainly in the loan market. And I think you could make the argument that there is some incremental value there, especially when you think about some structured products that package up loans, like a CLO. There is some value there. But it's sort of buyer beware. You have to be careful about what you're buying. You have to look very carefully at the managers, at the loans themselves. And so we would take a somewhat cautious approach. But those prices were down pretty dramatically just a month or two ago, and so there was some genuine value there. Our central message for kind of high yield overall, though, is take a more defensive stance. So be realistic about what the asset class can actually deliver. Anything greater than a 3% return, once you start to sort of carve out sort of the more risky or less liquid parts of the market, would be impressive in our opinion, given where yields are starting, given where spreads are starting. But at 2 to 3-ish, call it I would say like a 3 to 3.5% total return on a relatively low risk profile portfolio is very achievable.
Kathy, I know your take is that we've seen the price appreciation. I imagine many people share that view. The next year for high yield, a story of coupon income. For you, though, George, investment grade, I was looking through your base case, just a bit of spread widening in there through 2020. What's driving that?
So I think it's a couple things. Number one, we've had a tremendous, technical backdrop, huge inflows into the asset class. Now that's across fixed income overall, so we think that moderates. But the other thing that was a big kind of sea change this year is a lot of investment grade companies actually started to reduce debt. And you don't typically see a company deleverage voluntarily. But we had a few very big names, very large cap companies that purposefully tried to delever or modestly restructure their balance sheet. The pace of that is likely to slow next year. And the pressure on companies to continue to do it is likely to slow. So slightly higher yields, a little bit less sort of demand or inflows into the asset class, combined with kind of less what I would call credit-friendly activity, means spreads modestly wider. And I think that's our base case, and I think there's a reasonable probability for that.
The guys will be sticking with us. Still ahead on this program, the final spread, the week ahead, featuring a holiday short and trading week. We'll get their 2020 conviction calls next on this program. This is Bloomberg Real Yield. From New York City for our audience worldwide, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. Coming up over the next week, on Monday, a slew of US economic data, including durable goods orders and new home sales. Tuesday, markets in the United States closing early for Christmas Eve and remaining closed through Christmas Day. Wall Street reopening on Thursday with initial jobless claims, and on Friday, China reporting industrial profit numbers as well. For some final thoughts, Kathy Jones, George Bory, Jim Bianco still with us. So guys, just to whip through all of you, the conviction trades going into 2020, the calls. And Jim Bianco, just beginning with you. What is your conviction call going into the new year?
I think it's going to be lower yields. Just
George,
to be very
short and very straightforward, lower yields. George Bory, is that what you're looking for?
Yeah, we would say steeper yield curve is our highest conviction view as it relates to rates. And then, on the credit side, I think it's protect your capital. It's sort of, again, like there's an inverse between that steepening curve. So move down the curve for spread and on that kind of steepening bias.
To be clear, though, the steeper yield curve driven by the long end, higher rates on 10s, 30s?
By primarily 10s. 10s will be the pivot point, and 30s moves a little bit slower.
Kathy?
Yeah, we'd agree. Steeper yield curve driven by higher rates and wider credit spreads, especially at the low end of credit quality.
Can we put a number on those wider credit spreads? What are you looking for? Some modest spread widening from George Bory.
Yeah.
What are you looking for?
Investment grade, I could say modest spread widening, but high yield, it doesn't take much to blow out 100 or 150 basis points if you get a hiccup in the market.
1 to 150 potentially on high yield.
It can happen.
From where we are. Jim, your thoughts, just finally, just to get a little bit of debate and pushback around here. There is a consensus here about curve steepening. You don't share it, do you?
No, I don't share it. I think, like I said, the curve is somewhat related to your rate call. And if I've got rates going down and the curve being somewhat anchored, unless something dramatic happens, then you're probably going to wind up with some flattening of the yield curve as well, too. So I do think that the story has been, actually this curve has been flattening since 2014. And maybe it bottomed for good in September of this year.
Yeah.
But it has been in a long downtrend. And I suspect that we're going to continue to see it move at least flatter. I don't think we'll maybe get all the way back to September's inversion, but I do think it's going to keep going lower.
Guys, let's do it. Let's get to the final round, the rapid fire round. 3 quick questions with 3 quick answers if I can. The 10-year yield, the high of the year, 280. Can we retest the higher 2019 in 2020? Yes or no, George?
Can we retest the high of the yield? Yes.
10-year at 280. We can get back to 280.
To 280? No.
Kathy?
No.
Jim?
No.
US 2s versus 10s, steeper or flatter through year end into 2020? Steeper or flatter? I've got a decent idea of where this is going. Kathy?
Steeper.
Jim?
Flatter.
George?
Steeper.
Final one, the FOMC. Unchanged through the year, rate cut or rate hike? Jim?
Cut.
George?
Unchanged.
Kathy?
Unchanged.
Hey guys, great to catch up with you. Kathy Jones, George Bory, Jim Bianco, thank you very much for joining us, and thank you to you at home from New York. That does it for us. I'll see you in the new year. Enjoy the holidays. This was Bloomberg Real Yield. This is Bloomberg TV.